Hi, I'm Jim Lineweaver. Welcome to our webinar. Appreciate you joining us. And what we're going to be talking about today is all the market volatility, which is here to stay. But what I wanted to do is even expand on that, because a lot of people in the headlines are seeing all the market turbulence, but a lot of people face a lot of risk on a daily basis, and it comes from a wide variety of areas. So that's why I brought special guest Laurie Steiner with us today. So thanks for coming aboard and really helping people out with the webinar, because we're going to share a lot of great information. And Laurie and I have a long history together back in the Gold Opportunity Show. And you guys have always done a great job of really helping our clients out, not only from estate planning, but also with elder law, which you are a specialist in elder care.
I am, yeah, and we're happy to help.
Yeah.
Takes a team.
It does, yes. And actually this coordination, which is what I think is so important, and that's what we're going to share to you tonight, because any one decision you make in a vacuum could lead to a lot of problems. But if you could pull your team together and have all those advisors talking and sharing information on your behalf, you can make educated decisions that way and really make sure you have a good financial future. Okay, so these are some of the disclaimers that we have. We're actually in 27 states, and I am a registered investment advisor. And we also have a broker-dealer called Triad, which is out of Atlanta, Georgia. So here's all the disclaimers and some of the legal things that we need to get through. No hard feelings against attorneys, but we do have to get these out there. Okay, they're all there in our disclosures. But also, you might have seen us in Cranes or on Channel 5, Channel 3, Forbes Magazine, WTAM, a lot of different publications, because we really try to pride ourselves on getting a lot of information that people can use for no matter what they're facing, whether it be financial, tax, legal, or insurance issues. That's why I also have a tax firm as well that's headed up by Mark Sykes. So everyone's situation is really different, and we want to make sure that when it comes to decisions, that these are going to be done and made based on your individual particular situations. So as we go through the 4 topics tonight that are going to be so important, try to figure out how they relate to you, take some notes, and there'll be an ability throughout the program where you can actually book an appointment if you like, and it's a complimentary consultation with myself, and also Laurie will make herself available as well, so that we can help you dot these I's and cross the T's of questions that come from the webinar tonight. So with the volatility that's out there, volatility plus risk really equals disaster for a lot of people. Now we actually are so far in what looks like a V recovery, because we had a huge correction. As a matter of fact, the coronavirus stock market volatility creating the largest daily price swing since 1929, which is absolutely huge. And Bloomberg even said that avoiding volatility is even harder than it looks like in the overall market. As a matter of fact, on February 19th, the S&P hit an all-time high of 3,386, and is followed by March 23rd hitting a low of 2237. So it's over a 33% point swing in your portfolio and in the market. And these are the types of volatility that if you're close to retirement or into retirement that you have to try to avoid. So we're going to talk about measures to kind of restrict some of this volatility so it can help you sleep better at night and also have a more comfortable retirement. The first strategy I want to go over with you is using income-focused strategies to help weather today's uncertainty. When you really look at generating income, whether it be for retirement, maybe to cover your requirement on distributions, or maybe even you want to make gift to grandkids and things, or pay for some of their education. When you look at your portfolio, you have to take a step back and do an analysis to say how much of the income that you want is coming out of these income-producing investments and how much might you be selling or coming out of the growth portion. Because if the income-producing assets don't cover everything you need, you're going to be dipping into or selling shares, and over time, that is not a winning strategy. And when I talk about some income-producing investments, it can be bonds or fixed income, it can be preferred stocks. You can even have stocks that are out there, common stocks that are paying good dividends, but the key is make sure you focus on the income producing side of the house, not just the growth. And this is a great chart to show you how bad things can get if you have to sell shares and dip into your principal. Let's say you wanted to buy a $500,000 house and you took a mortgage on that for 30 years, and that's going to be at a 4% interest. When you start making your payments, the majority of your payments is going to go for the interest, and a small portion is going to go towards your principal. And then over time, as the principal gets paid down, then you don't pay as much interest, and in 30 years, your mortgage would be totally paid off. The same thing is with $500,000 in a portfolio. If you're trying to generate monthly income, in this case, it'd be about $2,400 a month on a $500,000 portfolio, and if there's any given time that you have to take that income out and you physically dip into your principal or sell shares, that means you're doing the same thing as what's illustrated in this graph. Over time, your interest or your income is not covering your monthly payment, and gradually you're spending down principal, and actually, if you're not careful, in 30 years you could run out of money. That's why it's so important to concentrate on the I more than the G when it comes to your total return. What you're seeing on your screen right now is an ability for you to take advantage of a complimentary consultation with myself and also with Lori in order to help you really make sure that you're dotting your I's and crossing your T's for your individual situation. And you'll see a little portion up here on your visually on your screen where you can actually just click and schedule a 15-minute call with us in the convenience of your own home.
And now I'm going to continue on with strategy number 2. An integrated financial plan now can save you and your family hundreds of thousands of dollars later. So we talked about volatility and risk. Well, part of that risk comes from not knowing what, in some cases, the government's going to do. There are law changes. We've all seen that recently because of the pandemic, and the government has actually been working very fast to make law changes to try to help out the individuals in the country. But last year, they started, even before the pandemic, they were focusing on bringing more income into the government. So they made a big change to the IRA laws. The Federal Secure Act eliminated what's called the IRA stretch provisions. These have been used for decades to limit the amount of taxes that your heirs pay on IRA distributions as they come out. So how that worked, when a person dies and they're now leaving their assets through an IRA to children, let's say, you had to take it out during your life expectancy, and then your children were able to take it out during their life expectancies. They've changed all that. In order to avoid that long tax-deferred status and bring more money into the government to tax those IRA distributions faster, the new law requires that when assets go out to a child, under most circumstances, a couple exceptions, that it has to be taken out over 10 years. So that's a big problem. From lifetime, especially when you can leave it to your grandchildren over lifetime, to only a 10-year period. So it makes a huge difference in the taxes that that beneficiary is going to have to pay. So here we have an illustration. It shows a 50-year-old male who inherits $300,000 in an IRA. He also earns $100,000 a year and has an effective tax rate of 25%. So under the old law, every year he only had to take out a little bit, as according to the table based on his life expectancy. He'd take out $116,706. He'd have to pay taxes at his rate of $29,177. So he'd have left in his IRA still $387,805. On the other hand, if it has to come out over a 10-year period, he could have to take a distribution in each year of $384,530 and pay nearly $100,000 in taxes. So at the end of the time, he's going to have zero left to be able to invest or do anything with. It's just going to kill him in taxes. So over a 10-year period, under the old law, this same man would have about $475,000 in benefit from coming out of that IRA. But under the new law, his total benefit's only going to be at $288,397. Huge difference, $186,937 difference that he could have had, but the law changed, and we got to take account of that.
And that's a lot of money that's actually gone forever. You can never get that money back. So I'm all for paying my fair share, but I don't want to pay a dime more than I absolutely have to.
Right.
So what are some strategies that families can use in order to try to preserve wealth and really pass it to the next generation or skip a generation to try to help avoid this? There's gifting strategies out there that you can use. You can be proactive ahead of time to look at Roth conversions, because remember, Roths grow tax deferred and come out tax free, not only for yourself, but also for the generations to come.
So maybe you can pay a little tax now to save a whole lot of tax later on.
Exactly. And then also you can look at your required minimum distributions. I know they're suspended this year, but in the future you'll still have to take them. You might want to use those if you don't need it for income. You can leverage that through life insurance and get a great tax-free benefit to the next generation. And also there's creating Bloodline Trusts, which you're going to talk about here in a second. The real question is, should you consider a stretch IRA replacement strategy for your qualified assets like IRAs and retirement plans? If this is important to you, go ahead and click that toolbox on there so that you can actually set an appointment with us. We'd be happy to sit down with you and go over your individual situation to see if you could take advantage of these things that we talked about today.
So now I'm going to head into strategy number 3. This is something that we can work with to try to protect assets for the generations of your family, maybe. And it can also work with the IRA issues that we talked about. Your beneficiary has to take that minimum distribution over a 10-year period. And you're worried about how that child's going to spend the money, or that it's going to go to creditors or other problems or other medical issues maybe for that person. There's a way that you can use trusts to help protect that. Can have a tax cost. We're going to talk about pros and cons. But let's talk about an example first. So in this chart, we have John and Mary. They're married. They have a nice estate. And they have one son, Stephen. What they want to do is leave everything to Stephen. But Stephen's married to Susan. And they have 2 children, Amy and David. So it's pretty easy when John and Mary want to leave it to Stephen. It's just him. But now when he gets that asset, we've got a whole family involved. There are worries about Stephen potentially using his IRA distributions wrongly. Maybe he's a doctor and he's going to have a malpractice lawsuit against him potentially. Maybe they're worried about Stephen dying and leaving everything to Susan, who then marries somebody else, and maybe those assets can flow out of the family tree. John and Mary want to see Amy and David get those assets. So that's why we call this a bloodline trust. A bloodline trust is really designed to keep the assets all in the family, not to have them go outside to creditors, outside to divorces, outside to bad spending. So what would happen is John and Mary could leave everything to Stephen. Now Stephen takes his money and he puts it into a trust. The only way we can achieve this bloodline pattern is to have it go through a trust. So Stephen sets up a trust, and at his death, Susan can use it in as much or as little as Stephen determines that she should have access to it. And when Susan dies, it's going to be specified in the trust that it goes to Amy and to David. So we keep it in the family. While Susan's alive, before the money goes to the grandchildren, if she gets divorced, if she gets sued, if anything happens with her, that money is protected. Also, another way that Stephen's going to want to leave his assets, the IRA assets maybe to Susan, and he wants to make sure that they are paid out and kept in the trust so that Susan can use it, but she doesn't have the ability to take those distributions directly. So one way that a bloodline trust can work is to put minimum required distributions into the trust and then have it held in the trust. Now it has to come over 10 years, not Susan's lifetime. So in the past, it used to be able to come out over Susan's lifetime and very little tax every year. Now it's over a 10-year period, a lot of tax every year. And if it's in the trust, because we want the creditor protection rules and regulations so that nobody else can get that money, but ultimately Amy and David, there is a higher tax bill to be paid because the trust tax rates are higher than individual tax rates, but it's a tool to keep it all in the family still again. So there are pros and cons. Pros, as I said, protected from divorces, creditors, financial calamity, nursing homes, all those kinds of things. Assets can be protected from double or triple taxation, depending on how you set things up. And we can use this trust with other kinds of financial tools that Jim and I are talking about here today to make a good plan. Cons, of course, I mentioned that trust tax rates are higher than individual tax rates, so the heirs could be taxed at the higher trust tax rate. And you're setting up a trust, so there's ongoing maintenance, there's ongoing administration, there can be some higher costs to just having a trust agreement.
When you look at the Bloodline Trust, remember I set up for one for my family because I wanted to make sure that I could kind of control the distribution to my kids at certain ages, and that is really the only way I could put some handcuffs around them after I was gone, because I want them to, get out there, get out of college, get a good job, and not just become a trust baby like you see with a lot of people.
Yeah, I've met some of those.
Yeah, but trusts can be great. They can really be a phenomenal tool in your estate planning and wealth transfers. But if there's situations where, whether it be non-IRA money or maybe even just some of those qualified things, if you didn't want some of the additional expenses of a trust, there are different financial instruments out there that you can use that can also do a forced payment option, and it's literally checking off a box in the form. So if it's a qualified account, they can literally say, boom, it's got to be paid out over 10 years, no ifs, ands, or buts. That's it. And you're listing the beneficiaries, and you can list your percentages. If there's other like non-qualified or non-IRA assets that you want to, there's sometimes financial instruments out there that also you can check a box, and it might be a forced payout or even shorter or longer, maybe up to 20 or 30 years, but it can't go over the person's life expectancy. So if a bloodline trust is right for you and your family, this is a great way to get some information from Laurie or myself. Maybe even find out, I can dive into more details with you personally if you want to know what I did. But please check on the Schedule Now button on the right side of your screen to take advantage of the complimentary consultation that we'll be happy to do with you to see if this bloodline trust is right for you. Strategy number 4 is using current tax advantage strategies to help protect and preserve your estate. Some of the things that we're going to touch base on here are kind of beyond the scope of the program because I want to keep this to about 25 minutes. However, these strategies can be used by a lot of people. It doesn't matter on your net worth, it doesn't matter on your income, but they can be very useful tools for you. But it needs to be coordinated with an accountant. So if your accountant is just punching numbers for you, that's not the type of tax advice that you need. You might need some pro forma things done. What we do here in our firm is that Mark, the head of our tax company, we'll look at strategies, and then he'll actually run some pro formas for us to see what strategy works out the best in that given year for that particular situation. But you can look at qualified charitable distributions. Again, this year you don't have to do RMDs. If you're over, you don't have to do them at all, but then they'll be kicking back in next year at age 72. You have gift exclusions that you can utilize right now to gift money out of the estate, and there is a 5-year look-back period on that, but if you have a decent amount of assets or if you're proactive, then you can get additional money out of your estate with these gifting tools. And there's a lot of things that you can also coordinate with other charities that are a little bit beyond the scope of tonight's program. But if these are important to you, write them down. We'll be able to go over them with you when we get together with you individually for a complimentary consultation. But also, retirement asset risks increase with age. We always want to think we're healthy and going to be vibrant forever, but we're not, unfortunately. And there's rising healthcare costs. The biggest gap or the biggest statistic that people see in retirement is that they're going to spend almost $300,000 just in healthcare costs alone. And one of the biggest issues is to bridge the gap of when you retire at 65 for when you qualify for Medicare. But also there's long-term care expenses. My dad was unfortunately in a nursing home for 2.5 years before he passed away. My mom's going 10 years in an assisted living facility. They are expensive, and you have to plan for that. It could be an unplanned car accident. Who knows what happens, or somebody slips in your driveway. There's threats of growing disability. So there's a lot of different things that are out there, and we talked about a little bit changing not only laws from the estate planning test standpoint, but also from the tax standpoint, just like that stretch that Laurie covered earlier. So a lot of things that erode your wealth, you have to be proactive. So when you're faced with any of these as kind of a fork in the road, you've done the right planning so that you can choose the right path to help you get to your destination. What I want to do is give you a little example here of why tax planning is so important. So this is a client that we worked on with Mark, again, the head of our tax company. And this is a client that has about $138,000 of income. That's actually derived from about 30,000 municipal bonds. They're getting 28,000 in Social Security, and we've been selling some stocks along the way, so it's $80,000 of capital gains. You say, Jim, why did you do that when we talked about earlier, don't sell the G, we need the I? Well, in this case, and again, everybody's situation is unique, if we sold the G, or that growth asset, the capital gains rules say that this individual could take up to $80,000 in capital gains and still pay 0 taxes. So with a standard deduction, that's $24,800 for a married couple this year. Also a deduction of over 65, you get another $2,600 deduction, and then that capital gains allowance virtually wiped out all of their taxes. So literally, they can spend $138,000 this year and pay no federal taxes. So this is why tax planning is so important. It's not just crunching numbers, it's the strategies and the coordination that's so important, so you don't pay a dime more in taxes than you absolutely have to. So if tax strategies are something that's important to you, if you want to learn how to minimize your taxes, we can actually bring Mark Cypus, the head director of my accounting firm, in to these meetings as well. There won't be a charge for it. But if you want to take advantage of it, click that Schedule Now button on the right-hand side of your screen and schedule your complimentary consultation. We can also stress test your portfolio for success, and that can be part of, again, pulling the team together to make sure that you're going to have the retirement that you want. Our competitive edge in the marketplace can be your competitive edge for a successful retirement. If you'd like to log into our website, you'll actually see white papers there on a wide variety of topics. It can be covering all the financial, tax, legal, and insurance, and it's very timely information. You'll also see our newsletters there. You'll see the Financial Quarterback that I do on Sunday mornings. You'll see some of the shows that we've done with David Moss on Channel 8 on New Day. There's just a whole host of information that you can go to, and we want to be a resource for you. So whether you're just jumping onto our website or you want to give us a call to sit down with us, please take advantage of it. We want to help you out in any way we possibly can. Don't forget to join me on Sunday mornings on Fox 8. Right before Chris Wallace with the Financial Quarterback Show, where we bring a lot of special guests in like Lori to make sure that we're coordinating all your financial, tax, legal, and insurance. So Lori, thanks again for coming on the webinar today. Shared a lot of great information.
Well, thanks for having me, and I really think information is power.
And it is, and also the coordination. So when you can coordinate your advisors, your financial, tax, legal, and insurance, and really dot all those I's and cross all those T's, a lot of people can really have a successful retirement. So don't forget to click that button on the right and schedule your complimentary consultation. Lori and I will be here for you to help answer any questions that you have about your individual situation. Thanks again for tuning into our webinar.